a big welcome to Frost Law for coming. For joining us today for our professional excursion. Mr. Peter Paulson and his colleagues are here to speak about the tax incentives that are available to all of us in Puerto Rico. And if you're here as a guest with us and not registered for the conference, if you want your CLE credit for today, please make sure you see one of our staff persons to provide your name and email. We can get you your tax credit with your name and email. And I'll turn it over to Mr. Paulson.
Thank you very much. So my name is Peter Paulson. I'm an international tax professional at Frost Tax Law. I'm in Puerto Rico doing some taping for a YouTube channel we have. The channel is called Taking Shelter, and it has extensive discussions about this investment strategy. It talks about renunciation of U.S. citizenship and other topics of interest on an international level for people who want to explore those kinds of tax reduction strategies. I want to welcome all the people in person here. I also want to welcome all the people who are joining us virtually, and a special message to all the people here in person. You have taken a large first step in qualifying for the tax incentives. This is the big hurdle, coming to the island and experiencing it. After that, it's just a matter of a little paperwork and then staying on the island for the next 3 or 4 years as a bona fide resident. But you're really off on the right foot, so consider that. And if you decide to follow up on claiming some tax incentive programs, you're going to need some good advice. And we're fortunate to have with us one of the most qualified advisors on Puerto Rican incentives. And it's not just this. Act 60 is a whole quilt. It's a 400-page quilt and framework of a large number of incentives that are critical, mission critical to the economy of this island. And Jeanelle will talk more about that. But I do want to introduce Jeanelle Alemar-Escabí, who has got her own law firm, JEA Law, LLC. And she's going to talk about the history and the current requirements of this Act 60, Puerto Rican Act 60. Then on top of that, I think a lot of people think that the IRS and the Puerto Rican Treasury got together and cooked this thing up, and they're actually two very separate pieces of law. There's the Puerto Rican law that grants the incentive, and you might say, wait, I'm a citizen of the United States, I have to pay tax on my worldwide income. If you're a bona fide resident of a territory, that's not true. So the idea is if you're a bona fide resident of Puerto Rico, you pay tax to Puerto Rico, and they can figure out how to dispense that tax among their 3 million residents. And so if you're a bona fide resident of Puerto Rico, you pay tax in Puerto Rico. And the idea is you don't pay tax in the US on your Puerto Rican source income. And so, and that doesn't, it's not conditioned on whether Puerto Rico taxes you or not. So if Puerto Rico decides not to tax you, the US doesn't just sweep it up or top it up. Okay, so you can get a 0% capital gain tax rate or a 4% gain or 4% tax rate on your business income. And these provisions have been around for over 10 years, and thousands of people have done this. So it's not just a concept, it is in actuality working to improve the economy of Puerto Rico. You may capture the interest of the IRS. All the people that do this their names are published on the website of the development office, and so the IRS is aware of everybody that does this, and they are interested in this program. And Michael March will talk about that. Michael is an attorney in Frost Tax Law, and he will talk about some of the controversy aspects of this program, the IRS reaction, as it were, to this program. And then finally, there are some details in these rules, some special rules you have to follow, and I think one of the most important business rule when trying to get qualified business income is transfer pricing, to the extent there's a common structure that if you have a business in the US and you don't want to move the entire business to Puerto Rico, you just move yourself to Puerto Rico and you consult for that business back in the US. So the front of the business stays in the US, and then you as a consultant to the business have consulting income, which is eligible for the 4% tax rate in Puerto Rico, and combine that with the US 0 rate on that income. If you're a bona fide resident, that's how you get these benefits. But if you're allocating income from a U.S. business to your Puerto Rican business, you have to be concerned about something called transfer pricing, and William's going to talk about the significance of that. So without any further comments from me, I'm going to turn it over to Jeanelle.
Buenos días. Do I take the microphone right now? Okay. Buenos dias, good morning. My name is Jeanelle Alemar. Thank you, Peter, and thank you for that, the association for.
You need the microphone.
Need the microphone.
Yes,
I think we just have to remove this one.
I thought so. Thank you. Is that better? Okay, gracias. Buenos dias. Again, my name is Jeanelle Alemar. Thank you for the invitation, and honored and very pleased to be here and share with you what have become one of my passions to promote this incentive program. And you'll understand in a minute why it's not just a professional thing, it's also a personal thing for me. You can read about my bio later. I'm also on LinkedIn. But essentially, I've been blessed enough to been working with the private sector for years now, and also with the Puerto Rico Treasury Department, and in many nonprofit organizations, as well as the academia. And 6 years ago, I decided to establish my own practice, focusing mainly in precisely guiding people and business owners and people that are interested in doing business in Puerto Rico and relocating to Puerto Rico to let understand the business environment in Puerto Rico and these rules, and to see if this is a good fit for them so that they can benefit from the incentive program. Go ahead. I met with Peter a couple of days ago, and our conversation led to this introduction. I guess that most of us didn't dreamed of becoming tax attorneys or tax practitioners when we were young, right? I couldn't imagine my 5-year-old saying he wants to be a tax attorney. I wanted to be a storyteller. So I'm gonna, if you allow me, I'll tell you a small story about this Puerto Rico situation, political status, and how this incentive program was born. As you may know, Puerto Rico was a Spanish colony for more than 400 years. Back in 1898, the United States, after the Spanish-American War, they got Puerto Rico alongside with Cuba. Puerto Rico was not the target, it was Cuba. And you would be surprised that they got Puerto Rico for $20 million. Just the other day, they sold a house in Puerto Rico for $20 million. So initially, Puerto Rico was not necessarily one of the priorities of the United States of America, and Puerto Ricans living in the island, mostly Spaniards and other Latinos from different nearby islands, were resenting the presence of the American. It was a military government for a while. And then in the 1950s, some Puerto Rican leaders went to Congress and tried to negotiate a different political status. How Puerto Rico is an unincorporated territory. That means we're not a state. And that means that Puerto Rico does not have representation in Congress. And that has the consequences that we'll discuss in a minute. At that time, what was negotiated was that Puerto Rico would have fiscal autonomy. That means that Puerto Rico bona fide residents will not pay US taxes because they had no representation, and there's no taxation without representation. And that Puerto Rico companies will not be subject to US federal income taxes, obviously provided that they don't do business within the US. And then Puerto Rico could impose their own and develop their own tax system. That's what Puerto Rico did in the 50s. And they used primarily US laws as a model, obviously. But they also introduced this new tax incentive program to attract capital and to attract investment to Puerto Rico. That, alongside two special provisions in the United States Internal Revenue Code, Section 933 and Section 936, provided back then a framework for a lot of companies to move down to Puerto Rico, and initially was in the clothing industry, but that evolved from agricultural to clothing to manufacturing to high tech, which is what we have now. And through the years, these companies establishing their business in Puerto Rico, since they are not subject to US federal taxes, they're only subject to Puerto Rico taxation. Puerto Rico provided a very low tax rate. In the beginning, it was a 90% tax exemption of their income taxes. Now that has evolved into a 4% tax on net income and other benefits that we'll discuss in a minute. Fast forward 1996, this program already caught the attention of the IRS, And they established a committee to look into these manufacturing companies. In the meantime, Puerto Rico grew enormously, economy of Puerto Rico grew enormously. For example, the academia, we have the University of Puerto Rico has 11 campuses in such a small island, and develop a lot of professionals that was the labor force of these companies. Back then it was even bigger, but right now, this industry, the manufacturing industry, represents more than 40% of the gross product in Puerto Rico, GDP. So it's very important for the Puerto Rico economy, this program, this incentives program. What happens is that in 2006, Section 936, which was crucial for this to happen, because not only because it provided an exemption at the federal level, was eliminated. And the US Congress provided a 10-year period, phase-out period. So up to moving forward to 2006, a lot of the more than 300 multinationals that were doing business in Puerto Rico were gone, and thousands of jobs were lost. So Puerto Rico government needed to find other ways into attracting investment into Puerto Rico. That's how in 2008, the incentive law of the manufacturing incentive law was revised and in order to provide additional benefits. But also the government realized that that was not enough. We need to try to introduce additional benefits to other industries. And in 2010, it was approved the Renewable Energy Incentive Program. And also we had a film industry incentive program, tourism incentive program, and so on and so forth. The one that really started changing how things were going, it was kind of a game changer, was back in 2010. It was approved in 2012, but we started working with it in 2010. And I say we because I was fortunate enough to be part of the team that worked with this initial laws, what became Act 20 and Act 22. Act 20 was essentially a spin-off of a provision already existing in the manufacturing law. Manufacturing law needed services, ancillary services, and they. Oh yes, you can move on. Oh, we'll get there. The manufacturing service needed ancillary services, so they spin off the services into its own law and say, like, hey, if you're exporting service from Puerto Rico, and you need to have 4 things for there, and I'll go to that slide in a minute, but you can receive a 4% tax rate. And Act 22, which we're going to discuss, this 20 and 22 are the main laws that we are going to discuss. The 22 to me was a game changer, because the 22, for the first time, instead of incentivizing the business, the government of Puerto Rico looks at the taxpayer as the resident and the investor. The idea there was, you have these big companies, the shareholders don't even know where Puerto Rico is. This decision making, it's not done based on local criteria. So it's difficult for businesses to really get interested in the Puerto Rico development and the economy of Puerto Rico. So bringing the investor brings a new mindset, creates a new ecosystem. And that was the idea behind Act 22. And that, up to a certain point, is what's been happening. For the first time, we have here business owners and professionals with a different mindset, with a higher sophistication in business, and have created this whole new ecosystem for doing business in Puerto Rico. And what are these 2022 about? We'll discuss in a second, but just so that we can link into Act 60, since we had already what I call the buffet of laws. We got the manufacturing, we got the tourism, the service, exportation of service, we got the 2022, we got the film industry. The government decided to put that all together in what it is called the Incentives Code. The Incentive Code was approved in June 2019, effective 2020, and it's what it's called the Act 60. It was Act 60 of 2019. And the idea there was to promote the whole incentive program as a unit, not, and to aggregate the effort from all different industries and sectors to promote Puerto Rico as a place of investment. So fast forward to we'll go now into what we really like, which is taxes. Can we go the back one, please? As Peter mentioned, although we are here living in Puerto Rico, after Maria, everybody realized that it's not a foreign country. It is part of the United States, and but we're still subject to both jurisdiction. It's no different from any other state. You are subject to more than one jurisdiction: federal jurisdiction and state jurisdiction, or local jurisdiction, sometimes to 3 jurisdictions, county or etc. So it's not different in Puerto Rico. In Puerto Rico, you will be subject to U.S. federal jurisdiction, you will be subject to Puerto Rican jurisdiction, and you will be subject sometimes no, all the time, to municipal jurisdiction. Municipal are the equivalent of counties. And essentially, you have to keep in mind that that duality, but with this slight difference. Doing business in Puerto Rico may be like doing business in a foreign country if you're doing business through a legal entity, because Puerto Rican legal entities are not considered domestic entities for U.S. tax purpose. They're considered foreign entities for U.S. tax purpose. And comes all this new set of rules that you need to be aware of and in your tax planning. However, we got it's kind of the best of both worlds, because you are taxed as a foreign jurisdiction, but you get the protections of the U.S. federal laws, such as banks are regulated on the FCD, and bankruptcy law applies in Puerto Rico, and many other laws apply in Puerto Rico as well. I used to say, just as a joke, that Puerto Rico is kind of a teenager. You have some of the responsibilities and some of the liberties, but if you don't do things right, mommy and daddy will come and take care of it. So, and actually that's part of what happened. When Puerto Rico got this fiscal autonomy, they did very well for a long time. And these manufacturing companies provided a lot of economic growth to Puerto Rico, but most of that wealth was channeled through the government of Puerto Rico. The government of Puerto Rico became the primary employment and job creator in Puerto Rico, and the wealth was not well spread. And when 936 is gone and that it's closed, essentially what our teenager did was to max out the credit cards. And then mommy and daddy had to come and say, like, no, we're going to establish an oversight board so that you can get your finances straight. Right now, Puerto Rico is under the oversight board management. They are in charge of overseeing all the finances of Puerto Rico. And until Puerto Rico doesn't get at least 5 years of a balanced budget, they're going to be overseeing the finances, which I believe it's great, because now our teenager is going to finally grow up and become an adult. In the meantime, go ahead. Bona fide residency and regular taxes. This is not new. 936 of the U.S. Code has been there for a long time. And I like to divide residency in Puerto Rico in 3 steps. The first step is coming down to Puerto Rico and complying with residency at the Puerto Rico level. And I might not follow the slides entirely, so bear with me for a second. The first one, you move down to Puerto Rico and comply with residency, not bona fide, residency of Puerto Rico. In order to do that, you need to comply with the definition of residency for Puerto Rico tax purpose, which is mostly reliant on intention and if you're you have a domicile in Puerto Rico or not. So it's not as specific as the next step, which is bona fide residency, because residing in Puerto Rico will grant you essentially being subject to the Puerto Rico rules. But having bona fide residency is the one that would allow you to exempt your Puerto Rico source income from U.S. income taxes. And I will say that again, it's Puerto Rico source income that is exempt from U.S. taxation, not worldwide income. It's just Puerto Rico source income. And in order to comply with that second level of residency that I call, you need the regulations under the U.S. Code, and I'm going to defer on my colleagues here to further explanation, but essentially provide 3 tests that guides you into what does it mean to be a bona fide resident. The first one, and I'd like to start with closer connection, because although a lot of people talk about present test, You can comply with present test, but if you don't comply with the other two, you're still not a bona fide resident. So closer connection, which I say that you have to have a closer connection to this jurisdiction than to any other jurisdiction. And how you do that, Michael will probably explain a little bit more about that. Tax home test, which is essentially ask you to have for Puerto Rico to become your primary place of business and your or source of income and your primary place of residence. And the third one is physical presence, which is the most talked about. I have to be there. How many days do I have to be there? How much can I get away with for? My suggestion is don't think about this as days. Think about this, maybe you wake up one day and say like, you know what, I want to live in a Caribbean island and save taxes, by the way. But your primary purpose is to really move to the island and be a Puerto Rico resident. And the third level of residency is the one that provides you with the benefits on capital gains and other Puerto Rico taxes, which is the tax decree that you have to apply for and obtain from the Puerto Rico government. Just by moving down here, it's not enough. You need to apply for and obtain this document because it's a contract between you, and it's a legal document between the taxpayer and the government of Puerto Rico describing the benefits. Those benefits are so far available up until December 31st, 2035. Go ahead. If you come here under step 1 only and step 2, you're going to be subject to regular taxes. And regular taxes go up to 33% on income derived in excess of $60,000 of adjusted gross income. All other taxes that are relevant, it's alternative basic tax of 20%, sales and use tax, which I think is high, 11.5%, and real property taxes, which are determined by the municipalities. We have 78 municipalities, and each one determines their own percentage, but it varies from 8% to 10%, generally. Personal property and donations, it's a 10% tax also, and personal property tax that it's attributed to businesses are also determined by municipal government and also goes around 8%. Next. This, again, one of the things that I said, the first couple of slides we discussed, what does it entail in order to become a bona fide resident, and why does it work? How does it work to have an exemption for U.S. federal taxes, and how can you get even a better tax position in Puerto Rico? Regular taxes for entities in Puerto Rico, as I said, they're not subject to U.S. taxation. They're only subject in Puerto Rico for taxes if they are engaged in trade or business in Puerto Rico. And what does that mean? That means it's a very similar rule that is within the United States. Actually, we didn't have a specific definition up until last year that they defined being engaged in trade or business in Puerto Rico. Next slide.
Keep going.
Yes, keep going. Keep going. Okay, so now you moved down to Puerto Rico, you are up to level 2, and you have a business in Puerto Rico. And that business in Puerto Rico, if does not have this tax exemption, will be subject to higher tax rate, can go up to almost 40%. But if your business is within one of the eligible activities, provides one of the eligible activities, then your business can apply for and obtain this contract with the Puerto Rico government for 15 years. And for 15 years, it can have a very low tax rate of 4% on net income. The beauty of that is, again, if this business is not engaged in trade or business in any other jurisdiction, that's the only income tax that this business will pay. And distributions to the owners will not be subject to additional taxes by the Puerto Rico government. Obviously, if the person that owns the business is a resident of a different jurisdiction, that jurisdiction has the right to impose taxes on those distributions or dividends. But if the owner of that business is in turn a bona fide resident of Puerto Rico, as we already said, It's not subject to US taxes on that distribution or dividend, and Puerto Rico is willing to completely exempt that distribution and dividend from additional taxes. So essentially, you are converting a stream of income from anywhere between 30, 40, up to 50% in some states, considering federal and local taxes, to a 4% income tax rate, stream of income. And that helps, that it allows the business to grow faster because you have more income to reinvest in the business, and so on and so forth. Other exemptions that are included in the tax decree or the contract with the government is reduced tax rates on other taxes that I mentioned, such as personal property taxes, real estate taxes, and municipal license taxes are also have a reduced taxation. Go ahead. As I said, these incentives are not limited to one single stream of income or activity. You have several ways in which you can benefit. Actually, a lot of my clients, and I've had the privilege of assist around 400 business owners and business through my years of working with this program to establish in Puerto Rico, set up shop in Puerto Rico. A lot of them come down in Puerto Rico because of the exportation of service. But then once they moved down to Puerto Rico and they realized that the more Puerto Rico source income they generate, the more they benefit, then they start investing in other industries and other types of business. Go ahead. And what are the benefits for the individuals? As I said, once you go through all the 3 steps of residency and you get the tax decree with the government of Puerto Rico, you get 100% exemption on 3 types of income: dividends, interest, and capital gain. As you know, although money is money for most people in the world, for us tax people, money needs to be classified. And money is classified into buckets. Either you're compensated or you have rental income, dividend, interest, and that income is taxed based on sourcing. And sourcing is something not everybody understands, but it's key for this, because if the sourcing of the income is Puerto Rico, you can have 100% tax exemption on it. Obviously, the sourcing of the income is not Puerto Rico, it will be subject to some other taxation somewhere else. But one of the most interesting types of income here is capital gains. Why? Because capital gains are considered from sources of the place of the residence of the seller. So when you move down to Puerto Rico and you're the seller of a personal property that generates capital gain, that capital gains becomes, as a general rule, and there are some exceptions that our colleagues here will talk about, that will be completely tax-free. And that it's used in our strategies in order to maximize the benefits in the strategy when somebody comes down here in Puerto Rico, establish a business, and also gets the personal benefits. Why? Because not only the current stream of income will come at a 4% tax rate, but also the possibility of selling, of generating a capital gain and realizing the future value of that business eventually will be completely tax-free. It has been very attractive for service providers, software developers, and people that are starting up a business. Go ahead. Other types of investments are, for example, hard to recruit professional and young entrepreneur. These are the incentives that are intended for the individual. Although the first step with providing benefits directly to the individual was taken on 2012 with Act 22, after that, some other incentives directed to the individual were also implemented, such as a young entrepreneur, the physicians and the doctors, and also hard to recruit professional. Hard to recruit professional is a provision that allows an exempt business that it has a tax decree with the government to bring down to Puerto Rico employees that are hard to recruit in the island and incentivize them by coming down here, by providing them and negotiating with the government of Puerto Rico an additional tax decree for that individual employee, and providing that employee a full tax exemption on income over $100,000. This has been very popular with hedge fund managers that bring down talent to the island, and they are over $100,000. Everything over $100,000 is tax-free for them. Go ahead. Oh, I already covered this. Let's go forward. Well, I try to keep it simple as possible because there's a lot of U.S. rules that will be discussed by my colleagues here. But essentially, I wanted to discuss before I pass on the microphone, the most commonly used structure. As Peter said, a lot of people that are interested in coming down to Puerto Rico already has a U.S. structure. And the most common way of doing this jump into and leap of faith into Puerto Rico is essentially creating a Puerto Rico entity. My choice of entity, it's a Puerto Rico LLC. Why? Because Puerto Rican LLCs, number one, it's less formal than a corporation. It has a minimum publication requirements in the Puerto Rico State Department. And also it gives you a lot of flexibility for tax planning because it can be treated by default as a corporation for tax purposes. It could be elect to be treated as a partnership, even if it has just a single member. And it could be treated as or most recently, it has been allowed to be treated also as a disregarded entity, provided that has a single owner that is an individual resident, a bona fide resident of Puerto Rico. So essentially, the LLC starts providing services, if that's the eligible service that we're focusing, eligible activity that we're focusing, provides services to the U.S. group in exchange of a fee. And that fee, it's taxable at a 4% tax rate after, obviously, business expenses. And if that person resides in Puerto Rico, there are no additional taxes for that person. That LLC then, which can have this tax benefit, this beneficial tax treatment for up to 15 years, renewable for another 15 years. Eventually, if it's sold, it could be, again, receive a 100% exemption on the capital gain derived from the sale of this entity. I like the entity also because although you can do this individually and you can get the 4% on service income individually, obviously, I'm an attorney. I will always choose rather use an LLC for asset protection and division of liability. But also, if you grow your business and you hire employees, and actually you have an employment requirement of one employee if the business grows over $3 million in gross revenue. So, but that employee could be yourself. Could be the owner. So essentially, it's the most common structure. And if that's the structure, and I don't do this I try not to do this without a U.S. co-counsel because there's going to be always a U.S. part to every single strategy. And that's where it's very much relevant, the assistance of a US-based counsel that would allow you to understand what are the tax consequences of this structure, including transfer pricing rules and other possible outbound international tax rules. And one more thing before I let go, when there's more than one owner and one owner wants to stay in the United States and Puerto Rico, another box of Pandora opens with respect to control foreign corporation rules. So again, this is a tax planning that should be done considering the duality of this strategy. Thank you.
Perfect.
Yeah, go.
I'm one of the panelists, but I would like to ask this question. It seems that the key for the tax incentive is having an income that is sourced in Puerto Rico, right? Now, for you tax people, you know very well that there is an income sourcing rule under the U.S. tax code. It's the 861 rules on sourcing. Now, my question to you, Jeanelle, is which rules do you have in Puerto Rico a local rule to be followed with respect to sourcing, or do we have to follow the 861 rules under the Internal Revenue Code?
All of the above. The answer is we do. The Puerto Rico Internal Revenue Code does have sourcing rules, But the US Internal Revenue Code has their sourcing rules that also have a set of rules for possessions. And generally it's inverting the application of the sourcing rules for US source income. And obviously Puerto Rico sourcing rules try not to converge with the US sourcing rules. If there's a duality of sourcing, which has happened, and I'm going to say something about that in a second, then it becomes a beautiful challenge for us tax practitioners to determine and to give an opinion on where the credit goes and how to go about it. Sometimes it's even a matter of going to the Puerto Rico Treasury Department and getting a ruling on it. So that has happened. One common problem we had was 1201 rules, because I had clients that came down to Puerto Rico, sold their business under the bifurcation rules that will be discussed in a second. They didn't have to pay U.S. taxes on the gain, but they had to pay Puerto Rico taxes on the gain. That has been changed. Recent legislation changed and allows for the proceeds of such a sale to be considered U.S. sourcing.
Michael, I want to point out in your slides, there's a typo that it should be section 933 instead of section 833.
Oh, I apologize for
You
that.
might want to repeat that so people can hear that over your microphone.
Can you go back one slide real quick just for me?
Yep.
Perfect. Good morning, everyone. One more slide, Peter. There he is. Perfect. My name is Michael March. I am a civil and criminal tax controversy attorney for Frost Law in Annapolis, Maryland, and up and down the East Coast. Before I get started today, I just want to let everyone know I do not work for the IRS. I do not work for justice. I work for Frost Law, and the opinions I derive therefrom are based on my own opinion. A lot of that comes from public documentation, things that I've researched, and most importantly, Peter's YouTube channel, Taking Shelter. That's what I was supposed to say, right, Peter? All right, perfect. Can you jump forward for me, please? One more. All right, so a lot of this comes down to the Act 60 and the way that it kind of works in unison with the tax reductions that Jeanelle just walked through. But the first thing I really want to talk about is, what is that bona fide residence test? The first one that we see all the time is the physical presence, 183 days. But there's kind of some interesting dichotomy around that, which follows closely with the tax home test and the closer connection test. And immediately in my head, I go to the domicile issues that we see a lot of with people moving to Florida or Texas or different types of states. And a lot of times we see, all right, we have an apartment here in Puerto Rico that's smaller, but we have this massive mansion in Texas or in some other jurisdiction. And then the Form 8898 sort of also goes to these types of issues too. Where is your license? Where do you vote? Where do your kids go to school? All these different types of issues. So it's more than just being in here 183 days and sort of tracking that, which I'll talk about a little bit about later. But I think the bigger thing to know is that you really have to move here to Puerto Rico. It's a beautiful place. You have to come down, you have to buy some land, you have to enjoy it for 183 days. And the interesting civil and criminal tax implications of that afterwards is certainly interesting. If you can go to the next slide for me. All right, Act 60 kind of works in two different ways. The first way is with business entities. So as Jeanelle, I'm not gonna run through all the rules. Jeanelle did a fantastic job talking about it, but essentially moving a portion of your business or all of your business down here into Puerto Rico is gonna provide additional tax incentives depending on how much gross income you have for the period. What's going on there. More specifically, I'm going to talk about sourced income and sort of how that works, but in the interest of time, we can move forward one more slide, Peter. Perfect. So now we get into sort of the compliance issues, and the IRS has already put out publications that they're going to look into these individuals. And as Peter said earlier, unfortunately or fortunately, depending on where you stand, personally, I enjoy representing the misunderstood taxpayer. So I guess it is unfortunate to some extent that the Form 8898 has to be filed with the Internal Revenue Service. It has to be approved. If you look at the form, it's fairly intrusive, right? Like I said, it talks about your driver's license. It talks about your homes, where you're coming from. And it also talks about your source to income. So for individuals, the first thing that I look at, and Peter and I talked back and forth about this, we call this the Act 60 Sasquatch, is that this is the individual who kind of ignores the bona fide residence test. They don't hit the 183 days for one reason or another. And as I've worked over the last couple of years, a lot of the cases that we've seen in the criminal context is under 26 U.S.C. 7202 or payroll taxes, right? Failure to withhold and remit, willful failure to withhold and remit payroll taxes. And a lot of times on the payroll taxes, we see an automatic reconciliation of information that the IRS already has on hand, right? So they're looking at your Form 941s, they're looking at your PPP loans, and they're saying, what doesn't match? Let's look at this inside of a database, reconcile that database, and then kick out the individuals who have one problem or another. Either it's payroll taxes that don't match the PPP funds, or one way or another. Where I think this kind of applies in the bona fide residence world is I've seen firsthand trackers of private jets, public jets, people moving around, especially when you have a passport, a US passport, to say, we can definitively tell whether or not you've been in the island 183 days. And I think that's a fairly easy reconciliation that can be done by the Internal Revenue Service. One of the things that Commissioner Reddick did when he came in a few years ago was really work on these reconciliations like I'm talking about with payroll. So to see that kind of move forward in the context of these bona fide residence tests, I think is almost an automatic. And I think it's the first flag you would kind of see out there, right? That individual that's just ignoring it and kind of going. But I think that's more in the civil context. And I'll talk about how you kind of, there's really two routes into the criminal world. And I'll talk about those in a minute. But moving forward, the one that I really jumps to my mind in the business context is this sourced income sort of understanding and what we would call sham transactions, right? So the quintessential United States company is generating income. You look at these, the business owner looks at these types of tax incentives, and they say, we're going to move a portion of this business down here. Now, of course, as William will talk about and Jeanelle talked about, like, that can certainly be done with transfer pricing and having legitimate business operations down here. But I think the bigger context and sort of the elephant in the room that I'll talk about in a minute is what happens if it's all just kind of a farce, right? Like we're setting up a PO box down here or an apartment that's rented out on VRBO, and we're just kind of working through these transactions so that on paper they make sense, but maybe in substance they're not actually happening. So that's kind of what I see. I think the bigger thing, and I'll talk about this in a minute, is your tax preparers and your promoters. Like, how are they facilitating these transactions? Are they advising on these types of transactions? Certainly a very, very dangerous place to be, but certainly something that can be done at the same time. All right, so in the world of white collar crimes and specifically IRS crimes, there's not that many, right? There's probably 10 to 12 that we see on repeat. And I'm gonna walk through 3 or 4 of them right now. The one, as I was preparing for this, the one that immediately came to my mind was 26 USC 7201, because it's an attempt to evade or defeat tax. In application, I rarely if ever see this being prosecuted by the Department of Justice because it's very easy to defend. You can bring in transactions, you can explain your kind of thought process, because a lot of these crimes that you see, all of them are willful. You have to have the willful failure. You have to mean to do this, right? And I think there's a lot of explanation that can go into that. And what I'd rather see, and what I think the Department of Justice usually does, is they go after an easier charge because that's the quickest way to get to a conviction and to put it out there. Because I think the main purpose of the Department of Justice in these types of crimes is prevention, right? If they see somebody doing these types of things, they want to make sure that other people see it and they say, oh, wow, I'm not going to go do that, right? You get that Department of Justice presser, you get all types of information that are now published in your name so that everyone understands, and they kind of make an example of you. So 7201, again, I think this immediately applies to the issues meeting the bona fide residence test, right? So how are you evading tax? You're evading tax by claiming you're a Puerto Rico bona fide resident. In actuality, you are not, right? So you've evaded tax or defeated tax on some level in that way. Possibly also in the business context is the mischaracterization of income, right? Do you have US sourced income that you are now creating a sham transaction to show as Puerto Rico sourced income? But again, I think this is the last charge you would probably see. Some of the other ones we're going to walk through, I think, are much more prevalent and much more applicable. (7206) should be next. Perfect. Thank you, Peter. So 26 USC 7206 is actually a crime that I do see fairly often and being prosecuted fairly often. What is a false statement, right? So Form 8898, your 1040, your filing requirements in Puerto Rico would also be interesting to see how that would play into it. But essentially, it's the willful and knowing misrepresentation on a tax return, right? So we sign tax returns, the individual signs tax returns under penalties of perjury, knowing that what you're saying is the correct truth, right? You are telling the IRS or the other governmental agency the truth. Now, how does that kind of play in? 8898, maybe you're lying about your driver's license. Maybe you're lying about where your kids go to school. You're misrepresenting the nexus or the classification of where your home is. And in the other context that we've seen, especially in the domicile issues that we talked about before, it's right, where's your intent to be? Where do you want to remain and stay? That's kind of the thought process that I see behind those. False statements, again, mischaracterization of business activities or source of income. So where this would come into play and what I've seen so far is that you would shift your income, right? So you would have a US 1040 or a corporate tax return that reports less income than is actual. So you have $3 million in gross receipts. Instead, you report and recognize $2 million of gross receipts in the United States and $1 million of gross receipts in Puerto Rico, right? You've shifted that income so that you can take advantage of the tax incentives. Now, that goes down to the substance of the transaction. Is that actually Puerto Rico source income, or is that US source income that you're sort of moving around? So I think 7206 will be available. I think it's a much easier charge to prove to the Department of Justice than it is for 7201. So something that you will see, but the next slide or two is really what I think is going to happen here.
You might explain the 8898. It's a form you have to file to let the IRS know you've moved to Puerto Rico.
Yes, absolutely. Thank you, Peter. So Form 8898 is kind of like the application process. You submit it to the Internal Revenue Service and say, hey, this is the year, most likely you do it in the year of the move is what I've seen. So you say, hey, I'm moving to Puerto Rico, IRS. I'm going to stop filing a Form 1040 or my 1040 is going to drastically change. As a result, I'm a Puerto Rico bona fide resident.
Do you get a response from the IRS?
I think, do you not get an acceptance letter?
Because I've never seen one. Okay.
No acceptance letter?
You just have to save the return receipt that you mailed it. That's what we typically do.
Okay.
Interesting. Thank you for that, Jeanelle.
Sure.
Sorry, I lost my place. Where was I? All right, so 7203, again, I think this is certainly interesting. I don't see 7203s as much because it usually doesn't get to the tax law. So as a little bit of background, the way that tax crimes work is that the greater loss you create to the government, the higher your sentencing is. So if you cost the government $3 million, you're going to have a much larger sentence or a much larger proposed sentence to the judge than what you would have if you only cost the government $250,000. And there's levels that kind of work through that. There's a Department of Justice sentencing table that kind of walks you through that. So 7203 is usually a misdemeanor, as I've seen in the past. And I think the context of this would be, you didn't file that 1040, right? It's again, that misclassification of US source income to Puerto Rico based income. So certainly something that would be out there. I think that would be more of a civil context. What we do see in the civil context a lot of times is CP 2000 notices, right? So back in the day when I started my career, we used to have correspondence audits, and that kind of changed or morphed into CP 2000 notices. The CP 2000 notice says, dear taxpayer, you filed a tax return. The information that we have on hand from third parties doesn't match that tax return, right? You have 1099Ks that are more than what you've reported. You've got different mortgage interest deductions. It all depends on what's reported, but I would highly expect to see this in the 7203 context of, dear taxpayer, where's your return, right? Why didn't you file? And maybe that's interesting as part of the 8898 process of what happens if you don't get an acceptance, right? Maybe you get stuck in the process. I would imagine there's got to be some level of correspondence that says, hey, your 8898 stuck. Please tell us what's wrong, right? How do we kind of move this process forward? Because being in limbo could certainly have downstream effects that people probably don't see right away right now. All right, you go one more time. Perfect. So let's talk about the elephant in the room real quick. So most recently, Puerto Rico did have a prosecution or an indictment of Gabriel Hernandez, who was a tax preparer here in Puerto Rico. And he actually, so this is kind of leading into what I'm talking about. He was actually charged with fraud by wire, radio, or television. And it was 10 different communications that he put out there between telephone calls, emails. And essentially what had happened was that there was an undercover agent representing that they were from Arizona with a business. And Mr. Hernandez allegedly, or however you would like to put that into context, shifted $500,000 in income from the Arizona company down into a Puerto Rico based company, effectively shifting it from US sourced income to Puerto Rico sourced income, or more ineffectively, I guess, at this context. So, and this kind of speaks to the sham transactions that we were talking about before, right? Devoid of substance. So is there a business entity down here? Do you have employees down here? Are you actually doing some of the substantive work of the company? And immediately it goes to my mind of the management fees or the consulting part of your business down here. Is that actually part of what you've got going on? And through the emails and everything, it looked like basically, obviously, anytime you have an undercover agent, there's been an investigation going on for a little while. They know that you're kind of doing these types of things, and then they plant someone in there so that they can understand what is actually going on and gather more information. And that's essentially what happened to him. This is all public information, by the way, so I'm not speaking to anything that is undercover. But that's sort of the reality of it, is that the fraud in the wire, like you've got emails, you've got telephone, you've put information and documentation into interstate commerce that fits into the plan, and it's kind of the easy grab for the Department of Justice. And what's more interesting about wire and mail fraud is that it gives the Justice Department or the Internal Revenue Service the ability to go in and seize assets. So they can come in and take that pension, they can come in and take that 401k depending on it. So it gives them a little bit more strength behind teeth behind their prosecution to kind of get that deal done, right? The stats for the Internal Revenue Service Criminal Investigation Division came out the other day, and I think it had a 94% conviction rate. So if you think about how incredible that is.
So do they need to prove intent?
Yes, so generally, it's interesting. In mail and wire fraud, the Department of Justice is not supposed to use that as a standalone, right? It sort of piggybacks on 7201 or 7206. So that's kind of where the willfulness comes in. That's an interesting question, right? So
What about an honest mistake?
what about an honest mistake? They are all misunderstood taxpayers, Jeanelle. It's all an honest mistake. So I think that goes to what actually happened, right? So you've been advised by a tax preparer or a promoter in some circumstances to say, this is the business transaction you need to set up. Do you go set up that business transaction? Do you make inquiries into setting up real estate? Do you bring people, employees down here? Are you paying W-2s and all those types of substantive transactions? And what is really difficult in these investigations is that everything is on paper, right? There's a paper trail to absolutely everything. And the Internal Revenue Service over the last year or two, and the IRS generally runs the investigation, the Department of Justice takes over to prosecute. Is generally how these types of things go. There's other avenues that change sometimes, but in general, that's sort of the model of how it works. And they've gotten incredibly good at looking through other types of transactions. I've seen Zelle transactions, I've seen Venmo transactions. It's no longer the quintessential canceled checks or checks on the back of a bank statement anymore. It really is a holistic approach of how your business was sort of working and the communications that were derived therefrom. So.
Interesting. Thank you.
I'll go to the next slide, Peter. All right, so how do we get here? If I get $1 for every time I do a consult and they say, Michael, how did we get here? How did this end up being part of my life? And can I just go back and fix it, right? And the unfortunate part of this is that when you get into a criminal investigation, the first thing that happens is an IRS CI comes out to your house or place of abode, and they usually come with local law enforcement. They carry guns and badges, and they try and interview you right away. So they'll get in there and say, hey, this is what we're investigating. You're the target, you're the witness, you're the subject of the investigation. Do you want to have a conversation before this goes any further, right? That should be your cue to go grab an attorney, but sometimes you don't, and that sort of happens. But once you get into a criminal investigation, civilly, it's very, very difficult to get them to move backwards, right? That 94% conviction rate sort of speaks to that. By the time you're in the system and you're starting to be investigated criminally, we've got some work to do, right? So how do you get into the criminal investigation world? And this is, again, my take on things. And I think there's generally two ways. The first is what I see with the 7202 payroll taxes, where it's an automatic reconciliation of documentation the IRS already has on hand. Can they see your PPP funds? Can they see your Form 8898? Do they have travel logs of your plane? I'm not sure if there's travel logs of boats, interesting enough, but the automatic reconciliation of information they already have on hand, that is what I'm seeing in the 7202 context, and I think it's going to move forward in this context as well. So the automatic grabbing it right away. The other way that I see, and this is the more difficult part, and I think this is actually going to be more prevalent. So you file your Form 8898, you've been here for a year or two and you're reporting, and they come in, IRS comes in and says, all right, we're going to conduct a civil audit. Whether that audit happens through a correspondence audit or a CP 2000 notice, or if that audit actually happens with a person in a chair, is yet to be determined. But say you go through an audit, right, and there's an adjustment to your taxes that you have filed. There's something that was incorrect, whether it was willful or non-willful mistake, maybe up to interpretation. But what you do, and what I see very often, unfortunately, is you ignore the revenue agent. A revenue agent is running an audit. That's all that they do, right? After an audit is created or finished, you get an audit report that shows adjustments to your tax returns. How much do I owe because of my mistakes, right? That's the next step. So you ignore the revenue agent, you ignore the audit, you throw away those collection notices for some reason because you just don't want to deal with it. You think eventually it will go away. Denial. The next step after that is for a revenue officer to get involved usually. A revenue officer is only there to collect taxes on behalf of the United States. That is the only thing that they are there for. Revenue officers are one of the most powerful human beings inside of the Internal Revenue Service because they have the ability to refer you criminally, and it generally happens very, very fast. So in that context, if you ignore a revenue officer, they're going to escalate. They're not going to stop. So a revenue officer is going to reach out to you. They're going to call you. Now also be careful, because I do have clients that call me and say, hey, the IRS called me and they think they're a revenue officer and it's a complete scam. So be careful, right? But at the same time, if you have a real revenue officer who is after you, who is trying to work with you to satisfy this debt, it is in your best interest to communicate and work with them. They want to help you, right? I see in two different contexts. I see the people who ignore them and just let it go and say, I'm going to stick my head in the ground and this will eventually go away. The other one that I see, and I see it through representation as well as I see it the individuals, is they start to argue with a revenue officer. They start to be mean to them or callous or really demeaning. It's not the time and place to do that. It is really not. So work with your revenue officer, try and get those things done. So you ignore the revenue officer and they close the case, they refer you for a criminal investigation. That's when the CI shows up at your house with the local law enforcement and the investigation starts off. Criminal investigations usually run from 18 to 24 months while they gather their information. Most of the time it's in the form of a summons. So they'll summons your bank statements, they'll summons your credit reports, they'll start to trace down your mortgages. All those types of things that are very intrusive to your life. They'll also reach out to parts of your business. They'll interview employees, they'll interview subs. It's a very intense process. And a lot of part of what we do is run our parallel investigation at the same time and to see what they're talking to see what's going on, to see if I always say that there's three different stories, right? There's the Department of Justice stories, there's the taxpayer's story, and then there's the documents story. So what do the documents say? Do the documents say that you were actually trying to set up something down here and working with Jeanelle to set up an LLC, or were you just creating a sham transaction to try and save yourself a little bit of money on the backside? So that is kind of what I see.
Do you refer psychologists?
I am part therapist and part attorney at the same time.
All right. Well, thank you, Michael and Jeanelle. And my name is William Inchoco, and I'll be speaking about transfer pricing. And before I proceed, I just would like to show of hands. How many of you are familiar with transfer pricing? Oh, quite a bit. So, I have my slides prepared, and it's basically kind of like a transfer pricing 101. So you can refer to my slide, but I think in the interest of time, Peter, I think you just want me to kind of like get into the meat of things. So the transfer pricing rules has been around for many years. Actually, I was looking at my graduate studies notes, and it was around since 1917.
Wow.
Right? And in 1928, it was actually Section 45 that governs transfer pricing. And it has evolved, and it was only in 1954 that it became Section 482. And Section 482 is the statute that governs transfer pricing in the US. Over the last, I would say, 3 decades, we've seen growth in terms of the emergence of new economies around the world, the China, the Brazil, the Indias of the world, and we have seen OECD being active in their initiatives, countries enforcing tax rules, US businesses, more US businesses going around the world, and vice versa, many businesses are coming inbound into the United States. So these interplay of things created schemes by taxpayers to kind of like manage income and deductions, right? And it created a problem with the government, especially with the United States. The US government was seeking to increase revenue. And one of the things that the IRS has been focused on the last, I would say, 15 years, I've been here in the United States for 23 years, is the enforcement of transfer pricing, right? Because a lot of big companies, big corporations, and even small businesses, they have few subsidiaries around the world. They transfer goods and services, and they can manipulate prices. So up on the board, for example, is an illustration and basically on how transfer pricing works. So here you have a US parent with two subsidiaries, foreign subsidiaries, sub 1 and sub 2, and this could be in different countries, right? And sub 1 is foreign subsidiary 1 manufactures widgets, and foreign subsidiary 2 distributes widgets that is manufactured by the foreign subsidiary 1. So here, because they are related party, and if the subsidiaries are located in high tax, low tax jurisdiction, they can do some tax arbitrage. They can manipulate income and expense. So that's basically how it is. And if you're a savvy company with savvy tax professionals, then you can, manipulate prices. So what does transfer pricing do in this case? So basically, if you say, for example, sub 1 is in Puerto Rico, manufactures widget, and distributes it to a foreign sub 2, maybe in Mexico, or what's a good jurisdiction, Peter? Ireland, maybe? And that widget is being further distributed to the end users, customers around the world. So they can manipulate prices here. So to be able to clamp this down and make sure that there is no manipulation, the tax code, section 482, requires that the price between related parties is arm's length. So that's basically the buzzword, arm's length price. And what is an arm's length price? An arm's length price is basically the price that is recognized between two uncontrolled parties, two unrelated parties, without being duress by one to the other. So it's the arm's length price that is required when you deal with transactions with related parties. And it can be sale of goods, sale of intangible property, sale of services, and even loans and advances. So arm's length price is basically determined using some methodologies. And section 482, there are some methodologies there. There are, I think, 5 methodologies that's required and 1 unspecified methodology. Now, the rule says that you have to use the best method rule, and you have to determine this based on some factors like functions, risks, contractual terms, economic conditions of both parties, so that it is comparable to a situation where you are dealing with an uncontrolled party. So once you have determined the best method that is used, and those are this, you're probably familiar with methodologies like cost plus method, resale price method, etc., etc. And this will be evaluated by comparing it to something that is produced by a similarly situated company. For example, if you are, for example, Pfizer making Viagra, you probably would like to have your comparable price with Merck, who produces Cialis, for example.
By the way, both operate in Puerto Rico.
In Puerto Rico. Yeah, so that is basically how you do your comparison. So you have to benchmark it with something that is comparable, right? Now, how to do this is usually, so for big corporations, they would hire an economist to do the transfer pricing study, the econometrics part of things. And they will also hire lawyers to make sure, determine that, because in the transfer pricing process or study, there are some things that you need to consider. There are many things that you need to consider, and you need a lawyer to determine, where you are, what needs to be done, and then you do your economic studies to make sure that you have this comparability thing. And what is important in transfer pricing, arm's length determination is the report, the documentation. And we call it contemporaneous. The documentation under 482 does not require to be submitted with the tax return, but it is required to be contemporaneous, meaning that you have a study that is almost done during the same time as your return is filed or return is prepared. So that is the requirement. So you have a study. Now, maybe many of you do not have the Boeings of the world, the GEs of the world as clients, but smaller clients, right? Now, some attorneys would for practical matters, would advise that you just have to have benchmarking, just hire an economist and look for a comparable company so that, if they are cost plus 5 and then you're close, you should be quite near to that to that range to benchmark the comparability. But again, that is not enough. Benchmarking study is not enough, but you have to have I would say, complete documentation or report in addition to that, because that report would save you from this massive penalty under 6662E. So if there is an adjustment, for example, but you have a documentation, then that penalty can be mitigated. So again, for transfer pricing, the things that needs to be considered is that if you have a related party transaction, it should be arm's length. There should be the best method rule in terms of determining the methodology of the transfer price. And there should be comparability and documentation. So that is important. Now let's go to Puerto Rico in particular. So Puerto Rico, and Jeanelle mentioned that there's a lot of companies actually here, 300 companies, more than 300.
Back in the 90s, there were more than 300, but yes, we still have around 250 companies, and actually, I think that more than 90% of the entire Viagra of the world is produced in Puerto Rico.
So that's an advertising for you there. So Puerto Rico, with respect to transfer pricing, does not have its own statute with respect to transfer pricing, but it follows Section 482, and it generally really follows what 482 and its applicable regs provide. But it's interesting because in Puerto Rico there is a statute that says, I think it's Section 1033, I believe, of the Puerto Rico tax code. It says that any expenses that goes to a related foreign company that does not have presence in Puerto Rico but related to the payor, you cannot expense 51% of your deductions or your expenses. So that's in the tax code. Now, after 2018, there was a administrative determination. It's called AD, what's that? AD 2105, that says that, however, you can avoid that limitation if you have a transfer pricing study. And again, there is no guidance on what is transfer pricing study, but apparently it follows Section 482 guidelines, the one that I just mentioned. Now, so if you have documentation, you can't expense 100%. Now, the documentation, just like in the US rules, does not have to be attached to a return. But in Puerto Rico, you have to attach a certification. I think it's like a form something. There's a form that you have to attach to your return saying that we have made a study, and that study is available if requested by the tax authorities, and that is made under the penalties of perjury. So,
Yeah, generally the same tax transfer pricing being used for US tax purposes will work for Puerto Rico tax purposes. And most, if not all of the strategies that I've worked with include a transfer pricing consultation and or study.
right. So, and also in that form, I believe it is required that you have to mention who prepared your study. And I think it's a CPA firm or a business consulting firm. Now, I think there is some comments by local attorneys here that how about if it is done in-house? Because not everybody can afford a big,
I recall, it needs to be prepared by a CPA licensed to do business in Puerto Rico.
Oh, so that's clear now.
Yes,
Okay,
independent.
it needs to be prepared by a
The CPA
CPA
that's
or
authorized to do
authorized.
business in Puerto Rico.
Okay, all right. Very good.
Independent party.
Right. So that is transfer pricing in Puerto Rico.
Well, thank you, William. We left 15 minutes for questions from the audience or other aspects of this incentive program that we can talk about. I've got to get to a mic because that might not come off, and it's important that we repeat questions so that the audience remote can hear us. Anybody have any questions? Go ahead back there, black shirt.
So I know certain states have a use of the employer rule. How does that impact the Puerto Rican law against that? Like, what takes priority in the
What rule?
employer?
Now, you mentioned employer rule.
So, like, in New York State, for instance, has like the employer rule, which is like if your company has quoted you as an employee to spend it somewhere else, you have to pay New York State. You're supposed to. So I'm wondering how.
Oh, the state.
Well,
Like a remote employee working in Puerto Rico.
yes. Well, that's a very good question because just recently that topic was addressed. Obviously, before the pandemic, it was not customary for the companies to have employees working outside of the jurisdiction. We've seen that a lot because Puerto Rico works with a lot of multinationals, and they have to keep a log of where the work has been done in order to properly allocate the income generated by that employer. Obviously, after the pandemic, this has changed a lot. And we had a situation in which a lot of Puerto Rico, people moved to Puerto Rico to work remotely for their employees outside of Puerto Rico. That created a problem in terms of being engaged in trade or business in Puerto Rico. That was taken into consideration recently, and the Puerto Rico government passed a rule that American employee working within the Puerto Rico jurisdiction will not automatically trigger to be engaged in trade or business within Puerto Rico. So your employer is safe. However, you need to think about sourcing, where the money is being services. Compensation is sourced in the place where the work is performed. So now you're within a different jurisdiction performing the service. So that analysis it needs to be taken into consideration. Another thing that I want to point out is the misconception that moving down to Puerto Rico and providing services to a non-Puerto Rico employer will qualify you for the 4%. That it's not the case. If you want to provide services to an employer outside of Puerto Rico or a client outside of Puerto Rico, the relationship needs to change. You cannot. My suggestion is to consider establishing your own business as a freelancer and become an independent contractor to that an employer and other clients. That's a way. That's a lot of a common thing to do by people providing services considering this strategy.
That New York provision is a bad provision. My son's affected by it. He's got an office in New York City and he works out of Maryland, and that's kind of a result of COVID and just the way things shaped up. And his employer is KPMG, and KPMG is withholding both New York and Maryland taxes.
Wow.
And it's harsh. It's to have an office available to you. And it's for the convenience. It's supposed to be, you're not working in New York for the convenience of the employee, but yet when the employer's office was closed, they were still, withholding the tax from. So that is a particularly nasty little provision.
Okay.
So Jeanelle, there is no reciprocity, for example, with respect to those, with that scenario, like the tri-state area is trying to come up with a reciprocity rule, New York, Connecticut, New Jersey. Is there
Not
such
that,
thing?
not that I know of, not that I know of.
Another question?
The decrees are good for 15 years, but you mentioned they're renewable, but what happens after 2025?
We talked about two different tax decrees. The first one is for the business or individual person that decides to apply for the 4% in relation to compensation derived from services. That one is good for 15 years, renewable for an additional 15, so it's a total of 30. The second tax decree or the second benefit, it's for the individual, and that covers capital gains, and that one is good. There's a sunset in the law currently that it ends on 2035. What happens at 2035? If you haven't sold your business, your capital gains will be taxed at a regular tax rate, and probably an allocation will be allowed with respect to the increment in value while you were a bona fide resident with the benefits. That I don't know. But another possibility would be for the government of Puerto Rico to extend further the benefits. So that's also very common to extend the benefits if it's reasonable.
Recently, there's been information document requests sent to certain individuals, 7 pages of questions. I have not met anybody who has received an information document request. Can you tell us anything about those?
No, so I haven't seen anybody receive an information document request yet either. Hypothetically, what would we expect to see on it, right? I would assume it's the 8898 form, right? Like, where is your license? Where are your family? Where are you living? Those types of things. That would be towards an individual, which is usually what we see, right? But I guess in the entity,
Bank statements.
right, bank statements, of course, always bank statements, but in the entity classification level, like break down your sourced income, show us what your income is, do you have QuickBooks files, like the general things that they try and get off the ground to see how your business sort of operates. And then after the IDRs, I'm sure you're aware, we see the interview request right after that, right? Talk me through these documents, show me how this kind of works and fits together.
Yeah, the IRS has an active campaign out on this Act 22 investor incentive. It's been going on for over a year and a half. I've got some videos up about it. I even did an update, and then I quit updating it because nothing was happening. And now we understand there are IDRs going out, asking the type of questions that Michael was saying, just more intrusive, more probing than the typical questions asked on Form 8898, which is a 2-page form, which does ask a lot of probing questions. So that's starting to get serious.
One thing to consider is if this is intended for the business or the resident. As Peter is saying, there is a formal campaign to audit residency in Puerto Rico, and one of the things I suggest, and you correct me if this is not a good suggestion, is keep a record of your boarding pass. And buy a coffee every time with a credit card every time before you get into your plane. Things like that will, and every time I make an initial interview, I tell my clients and prospective clients, do not avoid an audit, prepare for an audit. From day one, you prepare by putting all this documentation together so you can always support your position of residency. And when that IRS officer comes knocking on your door, you have your file, you give him your file and a cup of coffee.
Yeah, it's kind of like what I see in practice is people get a little bit lulled to sleep because when you move down there, you don't have to file your first return or your Form 8898 until the following year. So you move down there. Most people move in the first 6 months of the year, and there are reasons for that I talked about in my last video. But you move down there in, say, March of 2023, and then you don't have to file your return for like over a year, almost a year and a half later. And by that time, you've left a whole trail of something. And now all of a sudden you've got this 8898 to put together and a tax return to put together. It's like, oh my gosh, now I got to get serious about it. And you know, when that time comes, I'm just afraid some taxpayers, you know, may not have done everything that they needed to do to demonstrate, which is the big fear, is that like a few people spoil it for everybody kind of thing. So I think that, you know, Jeanelle spends a lot of time trying to work with people to say, get this right from the start. And I think a lot of people do. Michael?
Yeah, real quick, it's canter towards the tribunal, right? Like if they're asking these types of questions, they know that something has gone wrong. And there's a huge difference between making an honest mistake and intentionally making a mistake, right? So you always want to be forthright. You always want to have the documentation and tell them honestly what has happened, because the last thing you want to do is omit a fact or maybe misrepresent a fact. The next thing you know, you're in the criminal investigation world instead of the civil audit world.
Yeah, what's a little surprising about this is that these provisions have been around Act 2022, and even their predecessors, but they've been around for over 10 years, and only like 3,000 or 4,000 people, I say only, but 3,000 or 4,000 people have taken advantage of this. There are that many people at a typical, or there are that many people at some high school sporting events. You know, is it really worth an entire campaign? Is it really worth the type of effort that is going into this? But I guess the IRS feels yes, they did a similar thing to the U.S. Virgin Islands system back in like 2005. Some of that litigation is still going on. So this is going to be a bumpy ride for some people.
I think what's also interesting is I saw some stats on the amount of income and taxation that has left the United States because of this program, and it is astronomical. So I think they look at it and say, like, let's make sure this is correct because this is costing us money, right? This is money leaving the United States tax system.
Yes.
Kind of more direct toward the criminal side of things. I'm here from Puerto Rico in Act 1, and try to follow the rules. My kids go to school here, I go to home here, all that stuff. And I'm curious because of the Hernandez thing you discussed there on the criminal part. Like, I'm getting by, I have tax advisors there, tax advisors in back Virginia here. I'm just curious, like, to what extent is, I'm just following what people are telling me is right, the transfer pricing study. How do you know you're getting advice from the right people?
It's a great question. Peter, you want to repeat it?
I just want to repeat the question. I think we've got somebody in the audience that is actually taking advantage of Act 22 or 20, 22.
Not individually, but.
Okay, Act 20. And the question is, I've done everything I can do really to get the best advice out there. And I know from talking to many, many people who have done this, it's all over the place. How do I get comfortable that I'm asking the right questions, that I'm working with the right people?
Perfect. Great question. First, get it in writing, right? So you've got your writing, your advice that you can say, all right, I legitimately relied on this person. Now, there's a wide array of professionals in life, right? CPAs to tax attorneys to attorneys in general. And I think it's vetting those individuals as well, kind of fact checking them, getting multiple different sources of information so that you can kind of reconcile what they're saying to you. But I think that goes down to the willfulness of it, right? Your CPA says to you in writing, this is the way to effectuate your business activities. And then you follow that plan with actual money and you're actually working through the system. Nobody's going to come in a criminal context and hold you liable unless it's incredibly egregious, right? Like I've heard some crazy stuff out there. But as long as you're working through it in a rational manner, I think, and the advice is written and you're kind of following it. Now there's always the smell test, right? If you look at something and say, how can that possibly be true? Then maybe it's time to investigate it and see if it is actually true. And there's lots of people out there to help, but everything's always in writing. Get your advice in writing.
Yeah, go ahead.
Like here and there are a lot of advisors, consultants, et cetera, who are this.
Right.
Yeah, and I think the plus and minus of the IRS interest in this program, we've been talking about a program that goes back to 2012, and just now we're getting the first enforcement. There have been a handful of people audited to date from what I've heard, and it's probably as a result of some other things that they were doing that got them audited, not necessarily the incentives. And now all of a sudden that wave is coming, and a lot of people are asking the same questions. I mean, you could technically need like 5 different advisors for a transfer. You can need someone to help you move, like there's some firms that really just focus on moving you, then an attorney in Puerto Rico, an attorney in the United States, which don't necessarily prepare tax returns, and then you need to find a tax return preparer in Puerto Rico, and then a tax return preparer in the United States, and you might need transfer pricing. You could, it takes a village really. And, if you've got a lot of stuff going on, like you're a YouTube influencer and you got, all kinds of things to do, it takes even more people to just make sure you're doing them right. You're not violating, you have to be opening a shopping center in Phoenix, you don't screw up your whole bona fide resident or a tax home test or something. So
And then by insurance.
it's such a complicated thing. And I think that's the reason why only 3,000 or 4,000 people have really done it, because it's formidable. And I think Jeanelle would tell you that just on the Act 22 individual investor side, you can have to pay $20,000 a year of donations, of filing fees, of tax return preparation fees. That's kind of the annual run rate, even if you don't sell anything, even if you don't take any advantage for it. So now you were going to say something.
Should he just call Frost Law?
But seriously, if you, as a lawyer, if I say to myself, I don't want to pay taxes, well, I understand this to mean I can run my practice from Puerto Rico and combine theoretically with this program and not pay taxes. Is that?
Yeah, I mean, that
boils down to, as long as you comply with the,
Yeah.
right. And I think,
as long as you spend 183 days and.
Well, if you're an attorney and you provide services, and the type of service that you provide can be, number one, provided from Puerto Rico, number two, remotely to a client, number three, outside of Puerto Rico, and number four, have no nexus to Puerto Rico, then yes, we can have a discussion on how you can qualify for the 4%.
I mean, one of the nice things about Puerto Rico is from a regulatory environment, people who are qualified there are qualified here. You know, it's portable. Regulatory oversight's portable, and that's kind of, you know, can be bad, you know, for someone who's violating regulations. But at the same time, if you're, you know, like an investment advisor, if you're an attorney or whatever it is, with real estate, you're qualified. You know, I mean, that qualification is portable. Yeah, question.
So let me pick up my friend Jeff Truman over here. So let's suppose I'm a professional mediator and I've got everything connected through the internet. I go to Puerto Rico, I do all the bona fide resident stuff, but my checks come from Baltimore, Maryland, or wherever. I can avoid the payment of taxes on that money coming from Baltimore from services I provided via Zoom to people living in Baltimore and litigating in Baltimore. And I'm good to go, and I'm not gonna get audited, there's just go home anyway.
Well, you had me up until that last point when you said I'm not going to
Exactly.
get audited. I mean, because again, you're going to have to file a form and you go there and tell the IRS, and then your name's going to get put on the website.
Like a big red flag to some of the 187 1,000 agents that are being hired. Ring off a bell that I'm sitting here in Puerto Rico, but I'm getting 1099s from Baltimore companies.
That's not a problem.
Well, my understanding, and all the tax attorneys here can correct me if I'm wrong, it doesn't matter where the payment comes from, because we are talking that you're providing services, as we said, sourcing rules establish that service income is sourced in the place of where it's performed. If you're performing the service down here in Puerto Rico, it doesn't matter where the payment comes from, that is Puerto Rico source income subject to the Puerto Rico jurisdiction. And because you are a bona fide resident, that will not be subject to U.S. federal income taxes. And if you apply for and obtain these contracts with the government of Puerto Rico, then that will be subject to a 4% tax rate.
So I can even go ahead and do a non-Roth 401k. I want to do a Roth conversion right here in Puerto Rico and transfer all that money from my 401k to my Roth.
No, distributions from a retirement plan are going to be sourced based on where you worked when you were covered by the plan. Yes.
What happens if Puerto Rico becomes the 51st state? What happens to these programs, these decrees? I know it's 50-50.
Okay, this is where I pick up my crystal ball and tell you. No, there's no way of knowing. However, yes, there is initially, statehood was not an option for most Puerto Ricans, but now things have changed a lot, and the majority of Puerto Ricans have voted to have a serious discussion about the statehood. So if it becomes a reality, my impression on it is that it's not going to happen immediately. This is not going to sound, there's going to be a phase out process of 5 to 10 years in which Puerto Rico will become a state, number one. Number two, even if that happens, as I said, this is a program that has been fundamental for the economy of Puerto Rico. And there are hundreds of multinationals working from Puerto Rico. This is not a matter of some consulting service companies with 2 or 3 employees. This is a big program. And generally what I've seen with programs, similar programs, is that there are grandfathering clauses that allow the businesses that had benefits to keep the benefits during the phase-out period.
That actually happened in the case of Hawaii. That Hawaii was a territory that became a state, and some of the incentives that Hawaii had put in place were grandfathered, even through the initial part of the statehood. We are at 11 o'clock. I just want to make sure that we get you all to the beach in time. You virtual people can go where you want. We're all going to the beach. Any final remarks? Well, I want to thank you all for attending the session. It's been a pleasure to be part of this program. And we look forward to seeing you back in Maryland.